Mm. Hello, everyone, and welcome to the LAI Phoenix chapter meeting for April. For those of you who don't know, Lambda Alpha was formed in 1930 to help foster the study of land economics. We are a global society with chapters all over the world. I'm Amy Winsky of AmeriCapital, and I am your president for 2021-2023. As we start our program, I want to remind you to post any questions that you may have in the chat box. We'll make every attempt to get all of your questions answered by the end of the presentation. I'd like to introduce Michael Klein of Freedom Financial Funds, who is also a member of our Phoenix chapter board. Michael?
Thank you, Amy. Well, welcome to today's conversation. We're going to be covering capital markets and with a focus on the middle market. The idea is that so many of these conferences talk about capital markets and then focus on deals that are sexy and neat because they're $100 million or $200 million, but the reality is that the deal volume is happening in a much lower segment of the market. And I'm excited today because I have Jake Martin and Tom Ryan with me, both of whom I've done transactions with, and both of whom do a lot of their volume in that less well-known area that we call the middle market. So what I'd like to do is take a moment here and ask Jake to tell you a little bit about his background, and then Tom will do the same, and I'll give you a little quick overview of what we do, and then we'll move right into the program. So Jake.
Sure. Thanks, Michael. My name is Jake Martin. I work for a company out of Baltimore called Alex Brown Realty. We are a private equity fund that solely does joint venture equity investing in middle market deals. So deals that need anywhere from 4 to 12 million of equity, total deal size of, 10 to 30 or 40 million, depending on leverage. So I came to Alex Brown 15 years ago, grew up here in Baltimore, went to college in Philadelphia, came back, worked for another real estate company for a few years, and then joined Alex Brown. I've been in charge of covering the Western US for our acquisitions group for the past, 12 years. So I'm primarily identifying partners that we hope to do value add transactions with, and that's across all asset classes and all geography within the continental US.
Hey, Tom.
Okay, Tom Ryan. I've been in the commercial real estate industry since about 2003, born and raised here in Phoenix. I've seen tremendous growth in our market. I've been with Churchill Commercial Capitals for 16 years. And so since 2005, I've seen some ups and downs in our market. Churchill Commercial Capital is a boutique commercial real estate advisory mortgage banker. We pride ourselves on finding our clients the best lenders and solutions that meet their, whether it's a short-term or a long-term need or their objectives. We look at, and that would be in terms of loan execution, loan terms, or overall loan structure. We've got about 15 life company correspondents whom we service loans with, and another 30 or so life companies we represent. And we look at all executions for our clients, whether it's a bank, a life company execution, CMBS, bridge, private money. We range loans from 2 to 3 million and up. No, there's really no limit there. We've done deals as high as 160 million. And it's really all about finding the right execution for our clients.
Great. Thank you, Tom. I'm Michael Klein, and I run a company called Freedom Financial Funds. Freedom is a mortgage REIT that has taken private capital and is using it to help real estate professionals add value to projects in the Western United States. I would say we focus probably on the lower middle market. So we're Tom goes unlimited, Jake goes up in to the 30. We just recently did our largest deal since we started this company 5 years ago, and that was 20 million. But the bulk of the deals that we'll do we tend to write checks that are in the $2 to $12 million range. So that's what we're doing. So each of us have kind of talked a little bit about the middle market, and I think we've covered that. But I guess one of the things is, Jake, you said I think 10 million. Is that your minimum check size, or will you consider?
No, I mean, honestly, it's really timing and partner related. We have some partners that we've done 25 deals with, and if they brought me a $3 million equity check, I'd probably do it. By nature, in this kind of middle market size, it's a bit of an inefficient business. So to be able to do repeat business is kind of key. If we raise anywhere from 200 to $300 million at a time. And so if that's 50 deals, to meet 50 partners is virtually impossible to run a business that way. So we try to latch on with partners that we like and that we have, a good track record with, or that have a good track record before we've met them. And we try to do repeat business. So, I've done equity checks as small as 1 to 2 million. If I'm advertising it to the group, I'd say 4 to 12, but there's always exceptions. We're currently underwriting an industrial strategy with a partner out of the Midwest that we've done, I think 12 transactions with. And he's going to buy truck terminals across the US and aggregate them into a portfolio to sell institutionally. And I was talking to him today about one, and the purchase price is 1.6 million. So, you're probably talking a few $100,000 of equity into that deal, but we know him, we don't have to underwrite him, and we're going to aggregate all these into something that will ultimately have 15 or 20 million of equity at the end of the day. And hopefully will appeal to institutional buyers. So it really, really runs the gamut in terms of how low or how high we'll go. And again, the timing part of that is just where we are in our fundraising cycle. If I'm sitting on $300 million, I'm going to try to probably keep my average transaction size at 10 million of equity. If we're still early in our fundraising, which we are, then I feel a little bit better about doing a $4 million equity check.
Right. And I would just echo that from a private lender standpoint, we're similar in that respect. We're very relationship driven, and so while I wouldn't take a $500,000 deal off the street, if for some reason one came up with somebody that I'd known and I've been doing business with, that we might, we very well might do something that small. But it's relationship oriented, and I think one of the things that it's unfortunately that terminology got sort of I don't know, messed with over the years, because I started my career in commercial banking, and it was always, we're relationship oriented, we're a relationship bank, whatever. And then of course there was a downturn in the late 80s, and that just showed that there were really, the relationships were a little transitory. And then in the Great Recession, we found out that really turned out to be the case, at least at many commercial banks, not all commercial banks. But I do have to say that doing the multiple deals with the same provider, in the case of Jake or Tom or me, saves effort for the user of capital, and certainly for the provider of capital, it saves a lot of effort. Tom, on your side, because you deal with numerous life insurers as well as some banks and credit unions and private guys, like me. What is there? Would you say? Could you kind of guess what the proportion might be of people that you would consider lenders or equity partners that you would consider truly relationship driven?
As far as, lenders, very relationship driven. Borrowers, they are too. There are some that aren't as relationship driven. But I would kind of echo what you guys are saying. I love repeat borrowers, love them. And where I see the middle market stuff is the $2 million to 20 million range. That's where I would say that's where 95 to 98% of our deals are done, is in that range. And a lot of them are done with repeat borrowers. And not to say I'll go down to, we've got, I think the air gets limited on the life company side when you start to dip below 3 million. There's not as many out there willing to do loans under that. But we'll go down as low as $1 million, for a repeat client, for sure.
So I think the common message for anyone that's on the use of capital side is relationships matter. And so kind of switching gears a little, but sticking with you, Tom, for just a sec. On the life company side, how would you characterize the bulk of that market today? Is it capital heavy, looking, aggressively seeking deals, or is it capital constrained or nervous or super optimistic? Where is the general drift right now?
Well, I think they're all challenged with getting money out. And from 19 to 20 to even this year, most of them are all increasing allocations. Some are matching the allocations they had for last year. Other ones are increasing it a little bit. I think the biggest driver is the scrutiny of deals. They are taking deep dives into every single deal they look at. I look at the life companies as, they're an investor. They're a balance sheet lender. They put it in their portfolio. They're looking at different things, metrics as from their side. But all in all, they're doing deals. And some of them, met their allocations last year, even during COVID. Not all of them, but I think you look back at 20 and they all went to the sidelines in end of March, April, May. I even had some deals fall apart that were about to be signed up, and they all came back in June. So some more than others came back. Some of them waited till August, September. But I think the thing is they want to do deals. There is definitely heavy scrutiny, and it depends on the asset class that you're trying to finance. And there's more structure involved. It's all in all, they're in the market.
Good. That's great. And Jake, on in the JV equity world, and from a global standpoint, not just an Alex Brown standpoint, are you finding that it's super competitive right now? In other words, tons of folks, doing deals, driving down on IRRs and competitive, or the opposite?
Yeah, I'd say it's pretty competitive. It's really, really hard to find deals that are interesting that are, brokered by the masses. I'll give you an example. We bought something in January of last year, so right before COVID, two industrial buildings in Austin, Texas. We bought them for $24 million. We've done one lease that hasn't really changed the NOI, and we're about to go under contract with an institutional buyer to buy it at $45 million.
There's no
So-
inflation. No inflation out there. No.
No, I mean, the NOI is virtually the same. It's a slight uptick, but not to that magnitude. So that just tells you, that's industrial. Multifamily is probably, feels even worse. So it's been, it's very competitive. I would say for the first time in a while, we've always kind of thought of ourselves as quasi-institutional. So we're not the Carlyles of the world or whatever, but we're also not friends and family. So we were usually the graduating step from friends and family. When someone wanted to stop collecting money from 20 doctors to buy something, they'd come to us. Well, now, the deals, the friends and family folks can't find deals small enough on the capital stack that they're coming up to play in our size range. And because more often than not, they're not quite as sophisticated in terms of their real estate backgrounds. They'll agree to a deal structure that most sponsors just can't pass up. I mean, it's just, we're trying to produce a return for our investor. So I can't give someone, big fees and big promotes and everything and still have the math work. And then there's just the other component is just the Carlyles of the world. They've all raised billions of dollars, and they probably 2 or 3 years ago wouldn't have even sniffed a $25 million equity check. Now for a repeat borrower or sponsor, I saw them do a $10 million equity check. So it's, and I know they don't want to do that. There's no way you can put out $5 billion of equity doing that, but it just gives you an idea of how much capital there is sitting on the sidelines trying to find opportunities that make sense to them.
Right. And I'm not sure that we've even felt in its entirety all the stimulus that has been and is going to continue to be pumped into the system here over the near term. I can tell you on the private lending side, specifically in the market that we serve, which is, again, we're in that bank alternative space. We're not in hard money or rescue money space, so it's a little different. But yeah, there's quite a bit of competition. Now the good news that we saw, at least in the first quarter of this last year, was that the transaction volume has picked up substantially among those people that buy and sell real estate. And that I think for all of us is a real good sign, because obviously we all need transactions well, Tom, I guess you've got maturities that you can roll on the life co side, but at least I know for certain that Jake and I have to have sort of new views of maybe old real estate I mean, there seems to always be a value add market, but if people aren't buying and selling, that doesn't happen. So I'm encouraged by that. I'm assuming, Jake, I saw you sort of give a head nod. You're seeing that as well.
Yeah, I mean, I think things are competitive, but the one upside is there's still plenty of lending options out there, and the money feels really cheap. Even debt funds, we're primarily borrowing, I would say, and this is give or take the last 2 or 3 years, it's been mostly bank money or agency lenders. We had typically stayed away from debt funds just because their cost of capital was a little bit more expensive. But we're actually closing tomorrow a student housing deal at the University of Alabama with a debt fund as the lender. So the cost of capital for the debt funds has come down. We've certainly seen more opportunities because of that. The other place I think we've seen opportunities is a lot of folks in kind of like 17, 18, 19, just said debt is so cheap, let's put 8 or 10-year debt on things. So we've seen some opportunities where we've been able to buy assets subject to loan assumptions with either agency debt or life companies. And it's one of the, we've gotten into a couple multifamily deals that way, just because, the loan is maybe 4.5%, and today it would be 3 and change. So there, you're able to get a discount for that. We looked at something recently in Albuquerque, New Mexico. It was newer vintage multifamily, and the seller wanted 26.5 for it. But then realized that their prepayment penalty was going to be too steep. So we, along with a partner, offered or negotiated for 23.5. So that's a $3 million discount just for the loan assumption. And if we think we're going to hold this deal for 5 to 6 years, we maybe have a year of prepayment penalty left on it at the end of the day. So that's one of the avenues where I'm seeing some opportunity in multifamily. I think student housing is different. The COVID impacted student housing in a way that, as most of us know, a lot of these college kids weren't taking classes in person. So we've seen a handful of newer vintage student housing deals that are allowing us to buy at a basis that's almost the par value of the debt.
Right. I mean, I can say this, we in our house, we happen to have one at University of Alabama. So, and she's been there the entire year. So, so that happens to be an interesting, and I'm sure you looked into that before investing in student housing. That's one of the schools that has stayed open, and the kids are there. They may not all be going to class at the same rate that they once were. There's more Zoom stuff going on, but it is interesting to watch that on the student housing. We don't play in that space too much, but yeah, that's very interesting. Tom, on your side of the world, where you're dealing with a lot of different lenders, and move away from the life companies for a second. When you're trying to fill voids for shorter term money, what's the general drift that you're running into in the middle market today?
Well, mostly the execution there is banks, with a 3, 5, or 7 year term. Some are going to 10. A fixed 10. But they offer a little more flexibility. Prepay tends to be a little bit better. It's a cheaper execution than a life company. So those are very valuable options. The one thing they don't typically do is their recourse, more borrower oriented than property, where life companies really look and rely on the property itself. However, they, when they get aggressive, they're borrower relationship driven. So when they want to deal with a strong borrower, they're going to go after it. So, but I think a perfect example is I just did an acquisition of a medical office building, and their equity was actually coming from a crowdsource. So there's quite a bit of delay in getting that finalized. So we never locked the rate. And we went in as a 10-year, 30-year AM. As rates, as you know, January and February, rates ran up 50, 60 basis points. So it actually affected the way we underwrote that deal. And being with a bank in that transaction and execution, we were able to downshift to a 7-year term. Rates jumped again, and we downshifted to a 5-year term. And that's where we ended up locking and closing once they got their crowdsourcing lined out.
Tom, Tom, I was just going to ask, what level of leverage are you seeing life insurance companies lending?
Maxing pretty much at 65%.
6.5.
Yes. Yeah,
So
and it depends on the asset class, really. I mean, they may go a little bit higher for a, an industrial or a multifamily. They may stretch from a 25 to a 30-year AM on those asset classes. I mean, I would say the life company world, their asset types that they like are, number 1 and 2 and 3 are probably industrial, multifamily, and self-storage, followed by retail and office. But those come with, they're doable, but they come with heavy and high scrutiny and some limited, like in retail, they want, grocery anchored. Power centers, not so much. You need to really deep dive into the tenant makeup, sales if available, the rollover. We're looking at rollover pretty heavily too. What's it look, down 5 years down the line, are we going to have a huge roll? I mean, they're really digging into this. A lot of it comes back to location. How did they fare during COVID? Were they okay? What kind of relief was offered? Has it been paid back? That revolves really more around the retail and office, but they're doable. I've done 4 or 5 over the last 12 months. Low leverage, but we structured them. Instead of doing 10, we did probably a 12-year to cover up a rollover in year 10.
Yeah, interesting. We just closed on a retail deal here in the Valley that where we were able to get to 90% of the cap stack as a senior lender, which made it possible for our client to write that check for the equity out of his own pocket. So sorry, Jake. But it's an interesting deal because one of the things that you see in markets like Phoenix, the 4 major metros in Texas, it's pretty common. And I'm not as familiar with, say, New Mexico. I just haven't done a whole bunch of business there, but I have seen it in Utah. Is that 15 years ago or so, pro formas worked by putting too much shop space on the centers, and so there's a bunch of that residual shopping center stuff out there, and certainly a lot of it here in the Phoenix area. And what was interesting about this particular business plan was that it was a substantially empty center, and there was a tenant in tow on filling up the big the big anchor space, but part of the business plan was to literally demolish 12,000 feet of shops. And so the center's going from an 80,000 foot center to a 68,000 foot center, but it'll be fully leased. And the numbers just work. And the numbers work for us to go to the 90% of the stack because it was building in a lot of profit in the deal. It was a very profitable release situation, and the buy was right. So that's one of the advantages perhaps of a private lender, which is a segue into a question that came in actually from someone I know, and is a great question. Is for you, Jake, and it is really with cap rate compression and with the cap rate compression and loan amounts on average, when you're trying to have an institutional lender that would be less expensive than say a private lender, leaving some gaps into where the loan to values come in. What's that doing to your ability to generate IRRs? If 5 points on the loan to value is going to translate into 5 points on the loan to cost on average or thereabouts, which means you're going to have to write a bigger check. What are you doing on that? What's happening?
Yeah,
with that?
it's a good question. And it's a little, I'd say it's a little bit deal specifics. A couple times where we've come across that, we've used our fund line of credit to essentially put in a little bit of, I'd almost call it pref equity. So we put in regular LP equity, and then we do a slug of pref equity that, we'll keep in there for 2 or 3 years and then assume we can refinance it out. Depending on the size of the deal, that's not always possible. We've generally tried to stay away from using third-party mezz or pref equity. We will, some of these deals, if they're lower leverage, we'll just acknowledge that the returns are going to be a little bit lower. And, but because of that, the risk is a little bit lower. And we'll just assume if this fund has 40 or 50 assets, that there's going to be something that's going to overperform and there'll be something that'll underperform. And at the end of the day, they'll offset to get us kind of where we want to be across the fund. That industrial deal I mentioned in Austin, we had to assume a loan there that was low leverage because they had put 10-year fixed rate financing on it the year before we bought it. And so we did a $4.5 million pref equity piece on top of our LP equity. And we assumed we were going to hold it for at least 5 years. And now we're getting surprised by the pricing, so we're going to sell it. But we've tried to gap things where we can to right size them. But we've also just kind of come to the conclusion that it's okay if, the deal underwrites to a 15 or a 14 and we're only 55% leverage, because there'll be something we can put 70 or 75% leverage on to offset it, which, if someone was just buying something one off, they don't necessarily have the luxury of doing that. But because we're a fund and we own multiple assets within the fund, we have a bit of leeway there.
Right. Great. So Tom, in the world where sometimes you need that extra pref equity or a second, have you seen much activity in that world, in that mezzanine, the second world? Are you seeing it much there?
I don't personally. Cindy in our office does a little bit more than that, and Jake's usually our first call.
Okay. All right. Great. Yeah. We get asked and oftentimes the challenge for us is that we just, and I think this is where Jake was coming from too, is you know, it's one thing to control the capital stack. It's another to be at the, you know, being controlled by the capital stack. And if you're a second, you know, say, oh, well, we only need a $2 million second, right? But the first is 20 million bucks. Well, you really need to have in your mind $22 million of capital, you know, and because if you've got to write the check to fix it, you need to be able to write the check to fix it. So we don't we don't do that very often. Now we do a number of deals where we go up the stack and then we internally separate the pieces and allocate them to the places that are, you know, more appropriate for the risk that's being taken, because we've got certain guidelines for what can fit into our REIT and what can't fit into our REIT, and so on and so forth. So that's how that gets done. I think well, I'm just trying to think back, and we talked about this a little bit. If you could try your best to sort of freeze frame sort of what the world looked like pre-COVID and what you were doing, and then look at what you're doing today, are there any significant differences today in your structuring or approach? I think, Tom, you already mentioned one about the deep dive on the tenant. Maybe that may be deeper a dive, but yeah. That comes to mind, and we'll start with you, Jake, and then Tom, as soon as Jake's done, make a comment on that. Jake.
Sure. From an asset class standpoint, I'm not sure that we're all that different pre-COVID than we are now. We were spending a large majority of our time working on industrial, multifamily, and medical office deals. Traditionally, we've kind of bought everything under the sun, but we just felt like if we took a more focused approach, it's just a more effective way to raise money, and two, it just makes us a little bit smarter in each of those asset classes. So today, you know, if someone called me and they had a conventional office deal, I would probably waive it off. Or if they had a development deal, which usually is 20% or so of each of our funds, I'd likely waive that off unless it was, you know, had a really interesting story. So from an asset class standpoint, I'd say we're similar. From a deal structuring standpoint, we've had to loosen our off the shelf kind of deals a little bit. You know, again, as we go down the capital stack, we're competing with friends and family. So if our typical deal structure a year and a half ago was us putting up 90% of the equity, the partner putting up 10, and those dollars being pari passu to a 10% preferred return, and then going 80-20 to a 17% preferred return, and then 60-40 after that. Now it's 90-10 to a 10 still, but we would, you know, it might be 75-25 to a 15, and then 60-40 to an 18, and then 50-50 above that. I'd say on the fee side of things, you know, we've kind of held to our guns there. And I think that's, you know, that's more just an alignment kind of thing. We don't want to fee our partner out of the deal before we even sign our first lease. We want our interests aligned. So we'd rather pay them an oversized promote if the deal does well, because then we're doing well too. So I think we've had to maybe lower our hurdles a little bit and maybe give them a little bit more of the upside. But you know, we had to do that some during the Great Recession as well. So it's not, you know, it goes it goes both ways. When things are good, we can be a little bit more stringent, and when things are harder, then we have to loosen our guidelines.
Great. Hey, Tom?
Yeah, I would agree with Jake. I mean, we're not really looking at things much differently. I mean, when we do a loan presentation or take on a deal to secure the debt, you know, I mean, our objective has always been, I need to answer all the questions a lender's going to pose and try to cover all the bases. So I would say, yeah, lenders are a little more conservative today, and we probably do have to do a little bit deeper of a dive into, hey, let's look at a little more operating history, or what's the occupancy history been, and the COVID relief. And so we are going into greater detail on a lot of those things. But as Jake kind of mentioned, you know, multifamily industrial has kind of just sailed through. Office and retail are a totally different story. I mean, we started seeing cracks in the retail a little bit before COVID actually hit. I mean, it was going well, but in the financing world, remember treasuries mid-19 were at, the 10-year was like 250. And we started having all the trade wars and so forth, and some other, you know, geopolitical stuff going on. And they really fell sharply. So that was a different kind of interruption to our marketplace. So lenders were a little squeamish then. They're a little more conservative today, I think. On the CMBS side, you know, COVID hit, spreads blew way out. I know the AAAs are now, you know, inside where they were when COVID hit. So CMBS is back rolling again.
Yeah, it's interesting. I would say, since we hold, you know, everything we originate, we hold. The reflection, the point or item that I would want to touch on is that after having lived through the year and a month or so of this thing, is that we've always underwritten people before real estate, and that's just our mantra. So, you know, I could recite it. You know, people credit real estate. That's how we look at things all the time. Every time. And we got through the entirety of the COVID with only one challenge, and it really, at the end of the day, you know, was a deal that was a new client to us. So we really, you know, could only go on the track record that we could do diligence, but, you know, not the track record of personal experience. And it just, you know, it's this disappointing situation, because it was a build to suit, so a tenant in place, and somebody that just found that they couldn't execute through the hurdles that COVID was throwing at them, you know, with slowdowns at municipalities and permitting and on and on and on. So that one's a little bit of a challenge, and it comes back to in my world to picking the right teams, because we had numerous other projects under construction or starting construction. We made construction, but we made 2 construction loans in April, you know, a month after everything shut down, you know, and when nobody had money. And those projects are done. We're out of one of them, and the other one I think is soon to be sold. So, you know, what we learned and was reinforced for us is that sponsorship, that, you know, the team, the brains. It's not, I mean, there's a whole school of thought out there that is real estate, but I can tell you, I've watched really good real estate people take really average real estate and make it fantastic, and less capable people take good real estate and make it really rather average. So that's a take home of what's really different is that nothing's different. It just reinforced the same fundamentals that we'd always had. I switch gears a little bit. When it's really competitive like this, and I think it's fair to say that we all concluded that it's really competitive. You know, it's like, is there an easy place to invest? I mean, is there some place that, you know, like it's easier, where it's not as much brain damage? And I'd be just curious if either of you have any insights on that.
I'd say where we're seeing some opportunity today and is in the hospitality world. We've traditionally always invested in hospitality with a narrow niche of select service, extended stay stuff, primarily Marriott and Hilton products. So the Homewood Suites, the Hampton Inns of the world. And so we decided, because we're fundraising, it's not a great fit for our fund at the moment. We don't want to have to tell that story to potential investors. So we started raising a separate like sidecar vehicle just for distressed hotel investment. And from a pipeline standpoint, I'd say we're seeing more there than in any other asset class. And you know, we have a strong record in hospitality. So we're kind of going up and down the capital stack in that, whether it's equity, whether it's pref, mezz, buying things outright. That's where we're seeing opportunity today. I mean, we're seeing other opportunities that we're doing, but I'd say that we're seeing the most robust, interesting opportunities there.
Right. Right. Well, everybody ran for the exit, so that's always the best.
Yeah.
That's always the best indicator of it's time to run in.
Right.
You know,
I would agree, Jake. And also, I think there's some good opportunity in retail too. I mean, retail's selling at higher cap rates, and I think it's coming back. Actually, I think going into, you know, throughout 2020, it was always the toughest ones were hotel and retail, and you know, office may be flip-flopping with retail. I think office has some challenges in the future.
Yeah. We've always sort of talked about office almost like land in our shop, which is to say we don't like land very much. So you know how we are about office. But on the other side of the coin, I have seen some interesting and nuanced little changes that have occurred in the office space. If you've got an office that you can access with stairs and not an elevator, it's more popular. Okay, and if you have an office that has windows that open, it's super popular. So I happen to have a client that had an investment in a garden office building in North San Diego County. And it came online literally C of O, May of 2020. So he was sitting there dreading the fact that he had a brand new office building completely empty, you know, spec built, thinking what a disaster. And as it turned out, it leased up super fast. And it leased up super fast because it had sliding doors and balconies and opening windows, and people were just dying to get out of the house, get into back into a work setting, but wanted the more garden office sort of situation. Now, I don't know how long I don't know if it's a trend or just a data point, but I can tell you that we happen to be in the garden space in our headquarters office in Calabasas, and it's full, and it's stayed full throughout. So I think I think there's always these little interesting niches. You know. So.
Well, I guess to that point, I've seen 18 and 19, you know, lenders' appetite for suburban office was not that great. You know, they would rather have the Class A, you know, CBD type stuff. And with COVID, it's turned around.
Right.
Now they would rather do the suburban office.
Yeah, it's interesting. on the hospitality side, we've funded some. We don't fund hospitality. We view it as an operating business with a huge real estate component. But what we have funded is some projects where there was no flag, or the flag had already gone down to the third tier, and it's now being converted to monthly rental housing, and we like that space. If we can we've got to find the right operator again, but we like it because it has this tendency to be extraordinarily affordable by the broadest, range of residents in whatever market they're serving. So you can do the back of the envelope and go, oh, the person that has a minimum wage job can afford to have a roof over their head. And so we've been able to finance a bunch of that stuff, and it's I don't think it'll last forever, but it's an interesting product while it goes. I want to just encourage the audience, if you do have a question, is to use the chat function, and I hopefully will see it pop up. If not, I will be prodded to see it, and I'll make sure that the question gets asked. We've got about 8 minutes left, and so I encourage you to ask questions. And with that said, I think I just got a note that there is a question. Yeah, no, I Nancy, I asked that one. So anyways, we move along. So what in the worlds that you see, besides, I mean, we've sort of talked about, like, okay, offices were challenged and retail was challenged, and certainly hospitality was challenged. But one of the points, I don't know if everybody saw this, but Uber reported record sales last month, and Lyft was back to pre-COVID numbers, and the movement of people through hired cars, so to speak, I think is a really good omen for an indication that people are getting out and doing things, and that I think will help. So, but is there any area that comes to mind that you think is particularly challenging today? Like, good luck finding capital, whether it's equity or debt. Anything come to mind?
Well, I guess there's probably 2 or 3 areas. We've traditionally done hospitality development too. I mean, you can't, no one is, at least that I know of, is providing equity to build hotels today. There's just enough distress out there that it does make sense. We just conventional office. I know you guys were just talking about how there's some opportunities. I think I think it's really hard to predict how things are going to play out from here on out. I mean, everyone's read the stories about big firms in New York, taking less space. Just from a personal standpoint, we're working in the office 2 days a week and at home 3 days a week. And we just had a survey sent out last week saying, do you want to start coming back to the office more? Do you want to keep it the same? Or do you want to, come less? And I think that it was somewhere between keep it the same and come a little bit more. I don't think everyone wants to come back 5 days a week, even though the large majority of folks have been vaccinated at this point. So I struggle to figure out where office is headed. I'm glad we never did, like a WeWork kind of deal or anything like that. They're going to have to, at least in my opinion, they're going to have to remake their strategy there. I don't think people are going to want to sit next to someone they don't really know in close quarters. And those spaces were kind of ungodly expensive anyway that they built out. So they're going to have to spend money to make it more COVID friendly. But I agree with you. I think the Uber numbers, just anecdotally, airport, being in airports seems like things are picking up. And then then there's the stock market that never seems to go down, or goes down very marginally regardless of what news comes out. So I'm bullish moving forward. I just I'm always torn because for good acquisition opportunities, we need distress, but we're also selling assets at the same time, and we don't want those to be a distress. So, so it's a catch-22. I wish I had a crystal ball, but I would be pretty leery of office. I would be a little leery of some retail. I just think retail was getting hit hard pre-COVID, and now I'm not sure how to value it today.
There's a couple of questions that came in, and I can address them pretty quickly. One was, change in cap rates and IRRs since COVID. I think Jake talked about the fact that IRRs may be down a bit because there seems to be a slug of capital that's all chasing the same sort of deals. So that's had some downward pressure. I would say the same happens to be true in what we're seeing in cap rates. We have recently done some updates on valuations, and we have not seen any. I mean, we're surprised by it, but there's been no slippage in cap rates. In fact, there's been tightening in a lot of markets, tightening, i.e. the numeric value has gone down. And I mean, we had a recent sale of a Chick-fil-A in a tertiary market at a 375. So I mean that's pretty rarefied air. So that hopefully addresses that. And then some developers looking at hotels to change them into multifamily. And have we seen these deals? And if so, what's your thoughts? And we closed a $20 million deal recently for exactly that purpose. So my thoughts are, I think it's bullish, and the point of it is that it creates housing that's affordable for the masses. And I think to the extent that you've got a third tier level motel that is never going to reflag up to a Hampton Inn or something of that nature, it's a great adaptive reuse for that type of property. So that's my 2 cents. Tom, final words, some other things you'd like to add to the
how much time do I have?
Yeah, we've got a couple minutes. We're getting towards that.
Yeah, I mean, I've got a positive outlook. I'm thrilled that the lenders came back as fast as they did when COVID hit and we had the shutdown. They've continued to lend throughout. Yes, we have challenges in some asset classes, but I mean, that's what makes my work fun, is figuring these things out. I think the pent-up demand out there, I've seen it a couple times. I took my kids, I've flown a few times since January, and both in February, and the planes were packed, the airports were packed, at least to San Diego this last trip. Weston Kierland was packed. I went there for a night or two, and it was packed. I just think there's a lot of pent-up demand, and another positive thing going on in our market is the in-migration. I mean, that helps all our asset classes, at least here in the Phoenix market. I think we just have to keep our eyes on the fundamentals. Haven't really seen that big of a break in rental rates across the board. You look at self-storage is leasing up at a faster clip than it has in many years. So I'm kind of bullish on it, and we'll handle the challenges. I think retail is probably a good buy right now, and I think hotels will be back sooner than what people think. And office, yeah, I mean, I think that's going to work its course over the next 12 months on the work from home and how that's going to work with employees and employers. So that's my 2 cents anyways.
Great. I think we're at the end of our time. What I'd like to do is say thank you to our panelists, Tom Ryan and Jake Martin, and thank all of you in the audience for participating and being part of our discussion today. I'm going to hand it over to Amy, who will close out the meeting. And again, thanks to everyone.
Thank you so much, Michael, for moderating, and thank you, Jake and Tom. It was incredibly informative, and we all appreciate your insight on everything in the commercial capital markets right now. Just very quickly, mark your calendars for May 20th. That'll be our next event, and you'll be getting more information via email on that. Thank you so much, everyone, for attending, and we'll see you next month.
Thanks.
Thank you.
Thank you.